special journals. I won't exactly tell you what the role of special journals are. More, I'd like you to come to understand for yourself what great benefit they bring. And I'm going to help you come to this realization just by doing a few basic transactions. And for the moment, we'll pretend that we do not have special journals. So let's look at what needs to happen if we sell inventory on credit. So we've got an example here: sell inventory on credit to NB Walton for $50,000. So what do we need to do? Well, we're presuming we don't have special journals. We only have general journals. A sale on credit would be this. Let's say it is June 1st. Accounts receivable, NB Walton, $50,000 debit, and sales revenue $50,000, being sale of inventory on credit to NB Walton. We also need to bring to account the corresponding reduction in inventory and the cost of goods sold expense. So what do we have? 50%. Therefore our cost of goods sold will be $30,000. And that's a debit, and therefore we'll have an inventory reduction in our inventory of $30,000, which will be a credit. And now we'll have bringing to account reduction in inventory for sale to NB Walton, and we'll call this journal G2. Now we'll go back and look at the next transaction. Sell inventory on credit to E-Air for $10,000, invoice number 53, terms 210, net 30. So I guess really I should have added this information to my general journal entry. So let's do that. Invoice 52. So terms 210 net 30, invoice number 52. Now our next entry, June 1st also, and it is accounts receivable, $10,000, and we have sales revenue $10,000, and that is sale of inventory number 53. We'll call that G3. And now June 1, cost of goods sold $6,000, being 60% of the 10,000, and inventory $6,000. Yeah, I need to fix this up too. Sale of inventory and credit to E-Air. E-Air on terms 210 net 30, invoice number 53. Righto, that's just two entries we have now made. Now let's pretend that's all we've got, but imagine if you made 50, 60, 100, 1,000 sales in a month. There's a fair bit you've got to do, but we've just made 2. Now we need to post these to the general ledger. So we go accounts receivable, June 1, NB Walton sale, reference is G1, that's General Journal 1, debit $50,000, balance 50,000. Now here I'm not showing any opening balance, but there probably was an Walton 103. So that's now to indicate that's the posting reference that has been posted to account 103. Now I've got sales revenue, and sales revenue explanation, but now this is June 1 sale NB Walton credit 50,000, balance 50,000. This is account 401, so this has come from G2, and I go back to the general journal and I put in here 401. 401 to indicate that I've posted this to the general ledger. Now I need to go to the next item, cost of goods sold. The account number for cost of goods, June 1, explanation, sale NB Walton. Well, really it is the associated cost of sales NB Walton. The amount was 30,000 and the balance is 30,000. The reference is G2. Just made me realise I put a wrong entry here. The reference journal reference area is still G1. So now that's G2. Now I go back to the general journal and I write in here 500 to indicate that's posted the cost of goods sold. Now I need to post the inventory. Now this again is likely to have an opening balance, whereas your temporary accounts may not have an opening balance. If there's been no other transactions in the period, they won't have an opening balance. Explanation, sale NB Walton, this was 30,000, balance is 30,000. The reference is G2. Now the account number we've been using for merchandise inventory is 120, but this will not be the same in all systems. So now we need to go back to the general journal and put in here 120 to indicate that it's been posted to the general ledger. Now I need to do the same thing for accounts receivable for E-Air, and then for sales revenue for E-Air, and then for cost of goods sold for E-Air, and then for inventory from E-Air. And then if I had another journal, I would need to do the same for cost of goods sold. I'd need to do the same for accounts receivable. We can now post this here also to the subsidiary ledger, and we go here NB Walton subsidiary ledger, NB Walton. I presume there's an opening balance, so I'll leave a space. June 1, reference is general journal, and debit 50,000, and the balance, we'll say 50,000, but if there's an opening balance it probably won't be. Now when we do that, I come in here and I put a T, and that T indicates that the item has also been posted to the subsidiary ledger. So the T is like a tick, it's been posted to the subsidiary ledger of NB Walton, and the 103 it's been posted to accounts receivable. Now I guess a few things you would start to see of A, how long your general journal would be, and then B would be in your accounts receivable, general ledger account, sales revenue, general ledger account, how much would be in your cost of goods sold, general ledger account, and how much would be in your inventory. Let's see what would happen when we use special journals. We do this. We have a transaction sale NB Walton 50,000. So we go June 1 account debit at NB Walton, invoice number 52, debit accounts receivable, credit sales 50,000, cost of goods sold and inventory 30,000. Now that is now the end of our entries. So we can see that was somewhat quicker. We haven't posted them yet. That was somewhat quicker to write. And we could put other information in here like the terms. Now we go also on that date, June 1, sale air, invoice 53, amount 10,000, 10,000 for accounts receivable and sales, and therefore it's going to be a 6,000 cost of goods sold and 6,000 reduction in inventory. Now we go through all of those and we put all our entries in, and here there's space for 8, but you know there could be hundreds, and then we total that up, and so here we've only got 2, that's 36,000, and we have total in this column of 60,000. So when we do our posting, just post the totals. So I would go to accounts receivable. So I go to accounts receivable, the general ledger, at the end of the month, so it'll be June 30. And bear in mind, this item no longer be there, and we'd have sales June, reference S1, that's the sales journal, debit $60,000, and our balance will be 60,000. So instead of potentially 100 entries in accounts receivable, we would have 1. 30, sales for June, credit 60,000, balance 60,000, S1, the sales journal 1, or 401 for sales, and we see that accounts receivable is 103. So special journals, we go in here, 103, 401. So we've posted a debit to 103 because debits come on the left, a debit of 60,000 to account 103, and a credit to account 401 for 60,000. Now we'd still need to put these items in the subsidiary ledger, so I'd go to the subsidiary ledger, down to NB Walton, and this bit would be the same, June 1, this will be S1 now, debit 50,000, balance 50,000, and I would come back to the special journal and go T. And then ER would do the same thing and would come back here after that's posted and put in T. So remember, a T substitutes for a tick, and here it tells us that we've posted the items to the special to the subsidiary ledger. Now I won't go on with this process, but I hope by now you have a sense of why we have special journals instead of posting every single transaction to the general ledger. And we've just looked at the special journal of sales for sales that we make on credit, but as well there's the purchases special journal for purchases we make on credit, then the cash receipts special journal for cash we receive, and really this is about money going into our bank, and the cash payments special journal, and that's for payments we make, and that's about cash coming out of our bank. Thank you.